questions there. All right, that was a really great panel about crypto payments, but we have another fantastic group of speakers about to join us on stage. And they'll be doing a debate. All right, I love debates. So the debate is going to cover crypto's house of cards, differentiating hype from substance. So I would like to first invite Quynh Ho to the stage. Let's give her a round of applause. She's from GSR. Thank you. Next, we have Irene Wu from Bain Capital Crypto. Welcome to the stage. Etienne, Mr. Etienne. TRGC, welcome to the stage. And finally, last but certainly not least, we have Matt Law from Outlier Ventures. Welcome.
Well, I guess we can start now. Maybe they're having lunch and they will join later with a full belly, but I'm sure we give them something to think about after this panel. I think why don't we start with some introduction, just a short one from our side. So my name is Quynh. I'm head of venture investment as well as corporate development at GSR, one of the largest market maker in this space. And I've been around crypto since 2017. Before that, I spent some time in M&A doing traditional, investing and advising company, like a lot of people here. Why don't I pass over to Irene?
Thank you, Quynh. My name is Irene. I am a venture partner at Bain Capital Crypto, which is the crypto fund of Bain Capital, the private equity firm. I most recently was head of strategy at Layer Zero Labs, spending about 2 years building that protocol. And before that, my background was in research on anti-surveillance theory and machine learning.
How about you?
I'm Etienne, managing director and founder of TRGC, so early stage venture fund, investing in pre-seed all the way to Series A, based in Amsterdam when I'm not traveling. So yeah.
My name's Matt Law. I'm Chief Commercial Officer at Outlier Ventures. Outlier Ventures is one of the most active Web3 pre-seed investors in the world. We run accelerator programs. We've been going for about 10 years. Worked with over 300 companies and projects in that time. Some big successes and lots of medium successes. The other thing that we do is we work with big ecosystem teams, Polkadot, Near, Filecoin, running ecosystem development programs for them, and so got quite a good insight, I think, into what's fake, what's real, what's fake real, and what's real fake.
Right, so let's get into the topic of meme coins, which I think a lot of people in this room probably think about or have heard about. There's a statistic that actually on Solana, there's about 500,000 projects launched in May. Let's talk about the barriers to entry. The second one is talk about Dogecoin. I don't know what about that coin, but it's bigger in terms of market cap than Chainlink, than Uniswap, things that people actually do use in this space. Pepe launched about a year ago, 5,000 times X in the last 3 months, right? And then now Celebrity Coin, right? Trump has a coin called MAGA, and then Caitlyn Jenner also have a coin. If you don't know who that is, you can Google that as well. So, and we see a lot of these Burj Khalifa type of candle, it's like go like this and drop. So what is your view of this meme coin? Should it exist in the market? Does it distract it from actually building some useful technology? Irene, maybe I'll pass this conversation to you first.
I want to hear one of you guys go first. We've conversed a little bit before this.
Yeah, maybe Matt and Etienne have very strong view on the meme coin.
Yeah, I mean, well, I've got a few thoughts on this, but the first one is, we're building open source technology here, right? And and so people can use it how they want to. Maybe it's not the reason that I came to this space, but I guess that's okay. And sort of like thinking more broadly, what's going on here, right? When you sort of step back, is this kind of big shift over, sort of a couple of decades about how the economy, society, and culture is organized, right? You got like 15% of the people in the USA holding crypto. Some countries you got up to 45% of people holding crypto, right? So you're going to get all of human experience on you know, on this new technology in the end. And so, you know, we're serious people. We do serious things. There are businesses, you know, there are open networks and that sort of stuff. But there's also people messing around. There's people speculating. There's people gambling. You know, that's kind of part of life.
We are speculators as well, sir. We call ourselves a fund. Listen, I'm Dutch, and Dutch culture, if you've ever been to Amsterdam, defined by, you cannot deny human nature. We're gamblers by default. We take risk. We call it investing. I'm not the type to pass judgment, right? Like blockchains, like you mentioned, are open source technologies where people will play in whatever capacity they see fit. If your meme coin has a 1 hour lifespan, you probably did it with the wrong setup, right? I have a friend in New York who launched 4 meme coins to 2 billion, and that's all he does. He's an expert at his lane, right? And to be honest, meme coins to me are a modern way of how people build options markets, right? Whether you hedge with it or as a way to outperform the rest of your portfolio that is still locked up for 6 years, people will play it. So I'm much more practical with it. Humans will do what humans do best, which is being irrational. And that's my view on it. And I'll end with this. I was in a group in October 2020 where the Shiba address was shared first. And 6 months later, Shiba bought my sister a house. So no judgment.
We're actually a lot more aligned than I thought we were before. Maybe things have changed in the last few weeks. Maybe you bought another home with meme coins, and that's why we've shifted views. I see meme coins as a fantastic demonstration of what's possible with permissionless technology. People using meme coins, launching them, that's financial freedom. And users generating their own optionality instead of deferring to institutions to create their own optionality. There are also new ecosystems that are using meme coins to bootstrap liquidity and like social fun prior to launching. Now, I think the converse take on that is if all of your original liquidity is from very strategic meme coins, it's very mercenary liquidity. So as someone who, for 2 years, focused on the go-to-market of an infrastructure protocol that is used by nearly every single chain within crypto, I think there are savvier strategies to building a sustainable ecosystem. But I actually think that there is no reason we should be censoring meme coins or the development of tooling around it, social gambling platforms. When I think about the money I've lost on meme coins, it actually just feels like social experiences I've paid for with my friends. I remember the exact place I was with one of my friends when I bought or made a very large position in Cost, which is the Costco hot dog meme coin. It's a very solid thesis, because the thesis is it will go to 150.
Is it
if anyone has
now?
spent time in the United States, Costco hot dogs have always been $1.50 through inflation and down periods. And that's just like a social experience. If you take the social aspect out of it, I don't think people would be nearly as interested in trading these meme coins.
Yeah, I have to say I probably agree with most of your point. I mean, investing should be fun. I think a lot of the time in historical investment, people need to wear a suit or have a broker account in order to trade all of these different things. And maybe it's the first entry point for a lot of retail to actually enter the space, whether that's good or bad. They actually learn the word crypto through this. And I think there's another, you can't take speculation out of investing. That's human nature. I agree with that. And I think there's a part about the recycling of money. Some people make money with meme coin, and they actually do then go into investing in real projects that building out technology. So I do think that there's some sort of financial recirculation in this space as well. So I think on this panel, we kind of see meme coin is not all that bad. But 500,000 coins being launched on Solana, there's a question mark as to whether that is too easy or not.
Can I say something else?
Yeah, sure.
I think we take ourselves too seriously. To what extent really do fundamentals really drive any price activity in crypto? So I think that it's not that much, and what's actually happening, I think, is everything is a meme coin, because what we've got here is we've got an attention economy where if you can drive enough attention, engagement, and interaction with your proposition, with your vision, and with your product, but we are at the early, we're still early. We're at this early stage of like this kind of generational shift, and what's happening here is, in a way, all meme coins and maybe all coins are part of like an advocacy or evangelization process of kind of converting, 10% of the world, 20% of the world, 50% of the world into a new financial paradigm.
I actually think I disagree with that. I think fundamentals can matter with token prices. And I think even though they're few and far between, there are generational companies and products that are being built right now. And if you think of, as we should, tokens as owning shares in potentially very profitable businesses, fundamentals eventually in a free market, I think, drive the most value towards these shares.
I do agree with that, but I think this sort of like the title of our talk is around like hype and substance, and I think they're not enemies. I think that the hype is needed to create the substance. What's happening is people are sort of like unable to effectively price, let's say, or optimistically pricing things based on a world that they think may happen, and there's a sort of self-fulfilling prophecy of that because one thing then creates the other. Or maybe.
I do agree. The space do need attention, whether it's good or bad. People do actually need to know about crypto, right? And maybe meme coin is one way to get there. So maybe we switch to a slightly adjacent topic to this. Substance does matter, narrative does matter. Around $5 billion worth of capital raising has happened in the past 5 months. Compared to, let's say, 30 billion in 21 and 22 alone, right? Each of those years are at 30 billion. Do you think that the market is overheating? Or we see all these rounds with 75 million for Babylon, 100 million raised just happened recently. Those actual projects are building something. Do you think that market overheating? Do you think there's a lot of capital are going to pour in and we're going to see kind of a slight collapsing in 2020, late 22 and beginning of 23 again? Maybe this is a big open topic. Etienne, you want to start?
I think the early stage market, I think that window is slowly closing, if not already closed, whereby myself and friends here, we funded the most egregious rounds. One round, 50 million valuation, 2 weeks later, nothing changed, maybe the color on the website, and suddenly the valuation is 200 or $1 billion. So I think the early stage market is pretty much way overheated, maybe already in Q1 earlier this year. The actually liquid markets, I still think we're kind of like in limbo. Bitcoin been fighting with the resistance that's like 70K. So I think that mania, we haven't seen similar levels as in 21 yet. So the early stage market is basically indeed a narrative festival. So narrative bingo. I'm building, we were talking about this earlier, folks building some sort of sequencer, bridging Bitcoin to Nair, or you name it. It's just a juggling big bingo of words. So I think the early stage market, in my opinion, definitely is way overheated. With tokens, just a beautiful GitHub at 2-3 billion. So that's definitely a landmine if you want to play there.
There's still a lot of capital to be deployed if you look at how much money was raised a couple years ago. And for most of the mega funds, they haven't even, maybe they've just hit halfway deployed, which I think also explains some of the rounds that these large funds participate in because they have a different mandate. Like the business model across VCs is not monolithic. And I think it's very difficult to return a fund that is north of $1 billion. That being said, investors have agency, and for a long time I was on the other side of the table. We were very fortunate at Layer Zero to have a very large and deep cap table, so I was able to observe very closely, and now at Bain Capital Crypto as a venture partner, I see how a different fund structure can motivate different ways of participation. So for us at Bain, we have not most recently come into rounds that we at least believe are overpriced or are not valued correctly, and I think, like I said, investors can exercise agency and not partake in these rounds, and the market will reprice itself.
And do you think to what extent that, you said that there's a lot of money in the market, right? But for example, if we see right now, there's a lot of overcommitment into these rounds. So there's, for example, anything, there's one side where if you raise anything with Bitcoin, staking or Bitcoin DeFi or something to do with like another layer 2 on DeFi on Bitcoin, there's a lot of funding around that. People are talking about it. Anything built on eigen layers, like there's a lot of capital going into there. But you also see some round that is very highly contested. For example, we committed something $1 million, and then the project come back later and say, sorry, we don't have any allocation. We have to give you 100K. So kind of almost you have to overcommit into the round, judging in mind that you're actually going to get pushed down about 10 times that, or you might get only 2 or 3%. That's at least what I see in Q1. In Q2, I would agree that there's a lot of things have calmed down. We do see a little bit of reduction, but in my opinion, a lot of those rounds are actually just being delayed. For example, if you raise a round right now, you're not gonna announce right now in the market. You wait until there's some event, like you launch or you have a business development. So I think those kind of oversubscribe, overvalue rounds are actually gonna be happening sometime in summer when it's actually announced so that we can track. Is that what you're seeing too?
My sense is that the market is a little bit overextended, and this kind of big bull run's been coming for a long time, and like Etienne says, sort of like not being reflected in the public markets at the moment. And I think people maybe are taking a breath now, and they're going, okay, well, we've actually got quite a lot down, a lot of cards laid out here, and maybe we need to start feeling a bit more confident before we go again. I think that's possibly one thing that's happening. I think also if you look at sort of the market, I think is sort of split into two parts. You've got sort of smaller, raises, maybe 50 to 100 million FDV, and I think that sort of operates in a slightly different way from some of these like crazy big, sort of monad 3 billion sort of things, which, that does look expensive, but at the same time, they were selling Polkadot at 1 billion during the last bear market, and that went up 50 times or something in the bull. So,
buyer beware. Oh my goodness.
Yeah.
To your point about overcommitting in anticipation of being pushed down, I haven't heard that, and I'm interested in where that maybe narrative has come into play, though I admit it's only been a few months since I started to be more firmly on the investor side. This might be a bit of a harsh take, but I see that as more of a skill issue, because venture capital, you're selling your capital. If it's treated as interchangeable with anyone else, it's highly commoditized. Ideally, if a founder wants you in their round, they will make space for you.
That's an interesting take. So I think that what I've seen evolving is definitely you can be rejected out of a cap table. However, the way that some cap table being constructed at the moment is that they would like to have some sort of a consortium of different type of investor on a cap table. For example, if I were to build a stablecoin project, I would need distribution channel. So I will lead exchange have 100K, 200K, 300K each. And then at the same time, I want market maker to take 100K, 200K, 300K, 500K each. And then I want some top tier capital, VC, tier 1, name it, lead the round or co-lead the round, and then some influential angels like Quynh. So because of that mindset of how founders want to build the cap table so that they can tap into different investor at the time they need it, which turned out has been quite useful, because I've talked to some of the founders, I've asked, who have been the most useful investor for you? And depends on the situation, depends on the time, they have pointed out different particular one. And it's not definitely correlated to the amount, I can tell that. So I think it's their time with definitely skill and also hustling, right, to get in. Their time is, I think a majority of it is the construction of cap table has changed significantly.
It's a push-pull, though, because I think for some of those funds that you try to get into your cap table for distribution reasons, given, let's say it's a corporate arm of, or corporate VC arm for a larger company, the mandate for their fund may be very different. So a 50K check actually could be fine for their target size. VCs should always be advocating for more ownership based off of what they need to return their fund. So I see that as actually a very good tension and dynamic.
Yeah. Absolutely. I think we, as GSR, we're a corporate venture, but we also have our own kind of venture ownership that we need to aim for as well. I do think that as long as the net benefit for some of the project we see it, sometimes we're willing to take some sort of a reduction if it's actually realistic for the project. But if it's too spread out, it's also advice for founders. It's very hard to manage your cap table, and later down the line, you're going to get a lot of people trying to sell their stuff and get out, right? Because they don't have enough skin in the game.
Yeah, I think that's if any of you guys are out here thinking about raising money, I think very carefully about those kind of big, broad party rounds, because you know what you actually want when the times are tough is you want someone with some significant loss aversion. Yeah. and if everyone's in for 100K, you're like, well, okay, well, we've got a bigger fish to fry right now. Is possibly what's going to happen.
I would be more extreme with that. If you get pushed down from 1 million to 100K, just say goodbye. Why bother?
If they I agree. I don't think that's happened to every single round, right? There are some part of it, and there's some. I think we come back to the part about how you can add value to the company and to portfolio company. We can touch on this point a bit, why sometimes VC would like to accept that point. But I agree, like sometimes you do want to, there's a mutual relationship. I think there's a time where it's a seller market and there's a time where it's investor market, right? And I think right now, the good things about this cycle I've seen is that we have a pretty balanced dynamic at the moment. There's some time in Q1 where I was a little bit worried whether it's too much founder friendly, but I think we get to the point where I feel pretty comfortable that there's an ongoing conversation between founders and investors.
I agree with you on that point, though, because for specific funds, if you don't get the targeted ownership size, it's a waste of money for your fund. You're just not going to return your vehicle.
And not enough people as well. You end up having too big a portfolio to manage. I agree with that, yeah. So let's talk a little bit about the deal structure perspective, right? Because we're touching on this over-allocation or under-allocated and commitment point as well. We've been talking about some discussions on high flow, low floats, high FDV, and some influencer-led round. Irene, I know that you have some take on that. Do you want to go ahead and talk about this, your take on the low floats and high FDV point?
Well, I think the key thing, and we discussed this before, is we all are part of venture firms, and some self-awareness is incredibly important. VCs, I think, play a very large role or are very complicit in the proliferation of high FTV, low float tokens. From the operator perspective, you have levers you can pull to actually launch with a lower FTV and set your token up for much greater success. Ideally, the chart you want is not one that's sharp up and down. You want a very smooth curve upwards. And so some levers you can pull are, don't list on exchanges that are pushing for a higher initial price. You can pull liquidity from there if that's the case. You can do slightly more generous airdrops, and in that way, make sure that your earliest community is actually growing with you all, without inflating the price and, I guess, giving off an artificial sense of a fantastic launch. And I think another thing, too, is too often I see VCs pushing for projects to launch tokens prematurely. And projects should launch tokens only once they've seen some semblance of product market fit, not only on the regulatory side, but also because then the community they're launching into is more stable to absorb the price impact of eventual unlocks. We can also talk about investor unlocks and my views there, but I'll stop for now.
Yeah. Maybe, Matt, you have some view here. You help projects launch and go to market.
Yeah, and I like what you're saying there, Irene, but one thing I believe is that there is this sort of fundamental trilemma. If you think, blockchain people love a trilemma, so I've got a new one for you, which is, if you think about founders and sort of institutional investors like ourselves, right? You know, they're the ones who are sort of active through bear markets, right? And then what happens is, you know, you do, what we're talking about here is building like broad-ranging networks with many thousands or hundreds of thousands of participants in it, token holders, if you like. If you think about that as like the retail component or the sort of real user component, you do need those people to come on board, right? But unfortunately, I think at the moment what's sort of happening is that and I think this FDV float sort of conundrum is sort of coming from this, because you kind of go, well, let's sort of suspend price discovery for a bit. Let's sort of do it this way. But what that's not doing is that's not helping the network develop over time. It's not bringing lots of new people in. And often what it does is it takes all the money off the table. So, you know, normal people are the exit liquidity rather than sort of like part of the growth story. And I think that's really important.
Go back to Christmas Eve, New Year's Eve 21. Solana was trading below 100 FDV. And everything after that went up with the market. So suddenly this cycle, I think it's more prevalent that with the help of market makers and exchanges, anyone within that, in the back rooms, basically painting whatever chart. And I know a few tokens out there, I can tell you afterwards, trading at 5 billion FDV, and it's like 10K on-chain volume. You already know what's going on there, right? So I think it's a phase of the market that will be corrected at some point. Or I guess the consensus internally for those teams is that once we get in a full public bull market, that thing will go up from there. As you mentioned earlier, it's trading at $1 billion or $2 billion. In the bull is probably going to go another 10x or 20x. I guess that's the strategy they're playing. If it's healthy, again, going back where we started, it's not my opinion to make, right? It's not my judgment to make. It's the gimmicks of the market. And it's been part of our history since forever, right? And even to our earlier point we made is that fundamentals or product market fit, I call it crypto product market fit, meaning your marketing, your KOLs, you name it, it's a whole recipe or playbook. Going public actually means, hey, who's the exit liquidity? Who's going to take the other side of the trade? It's who we are, it's how we structure our financial markets, and crypto is no different than that. The only difference I would say with, say, public markets is that Apple doesn't hire a market maker, right? Or NVIDIA doesn't do that, right? But
Well,
it's probably coming.
When they first listed, they need to have a market maker, but yeah.
Apple?
Yeah.
Those public companies?
You do need to have a book runner first. I think the definition of market maker in this space is slightly different to traditional market. But
You think Steve Jobs called the market maker, set the price at $20?
I don't think that's the job market
Exactly.
maker. But instead of derailing to that conversation, why don't we talk a little bit about one of the points that both you and Irene were talking about, which is all of you to touch on, is how do we maintain this kind of not the Burj Khalifa charge, right? Basically, you push the project, potentially the project are being pushed to launch too early because, hey, it's a good time in the cycle. I'm not ready yet, but if I don't launch now, I will miss the listing window. How do you help project actually go through that? Because founders have call and talk all the time about like, when should we launch? Ideally, I want to retain, keep working on this, but also my funding is running low. There's a good momentum in the market. If I launch now, my lockup, it's a lot of things that actually happen with all these tokenomic discussions as well. So a few things to touch on, but maybe we can talk about that first. I know, Irene,
Launching a token is incredibly difficult. It's also one of the most important product launches for any project, and so that decision should not be rushed. And I think between any investor, lead investor in a project, that should be an ongoing conversation and a very dynamic one. Different VCs have different approaches, and that's why I think founders should always be diligencing their investors just as closely as investors are diligencing them. For example, there are VCs in our space that can make money, and how they make a lot of money is by investing in projects that launch a token soon after or just when their network is launching, perhaps free with unlocks and that schedule. Maybe there's some inconsistency across KOLs and VCs, and then they can sell when it's high, and it's effectively a pump and dump, and there are many VCs who've made a lot of money that way. Then there are other investors who take a very different approach, and I'll speak for Bain. We often, when the conversation comes up with investors, push for longer lockups and push for consistency across the cap table. We've even pushed for lockups that go beyond 4 years, 5 years. It's a very different approach, and I can also, Bain Capital Crypto spun out of a very legendary large private equity firm with LPs that are endowments and very different institutional mandate type organizations. But I think investors do have a large role to play in the decisions that founders make. A lot of my founder friends feel pressured by their VCs. And if they want to build a generational project, they should wait until the project is ready for that moment. At Layer 0, we waited 2.5 years, almost three years since the mainnet launch. The token will be coming out in this quarter, and I think that was the right time.
I think there's, we can take some of the example as well. So we are on a cap table with some of the projects that actually based in between Europe and Asia. And we can see that some of the investor in certain geography have been pushing for, when we mentioned the idea that, oh, it should be about 1 year lockup and one year cliff and 3 to 4 year lockup, which is what we normally see now, which is helpful for founders and investors to be on it. Some investors are actually surprised, like, well, we normally do 2 to 3 months maximum. Like, why there's such a big cliff? It's like, well, clearly you haven't seen what's happening on this side of the pond yet, this side of the market. And so I do think that for founders, when you go and look at the cap table, I would irritate the point with Irene is that have a diverse, do the due diligence on the cap table who are your investor, but also check what they're doing with their portfolio company. If they really tell you that it should be 2 to 3 months cliff, they haven't probably heard the rest of the market is not doing that, right? And another way that if you already have, so maybe a controversial take here is that some founder doesn't allow staff transfer, which is people who like to get out fast. In my opinion, a lot of people have, VC have privilege to be able to enter some of the rounds, which is great. But if some VC doesn't want to be there and want to get exit early, you should allow them to do it because they would have done it on the day that you got to the unlock anyway. So this is, I think, in my view, it is one of the things that founders should consider it to clear up the cap table because it's a long way. You don't know DVC. You talk to them probably for, I don't know, 15, 20-minute pitch and then have another 2, 3 weeks of due diligence. But the time that you're working with them is probably 3, 4 years until you'll be able to launch. So there will be time where you need to clear your cap table if you don't find the right investor at that time.
I'm curious how you two think about lockups and also exits, since the mandate is very different for your guys' funds. We do seed through Series C and most typically lead rounds.
We don't have a mandate for lockups. It's more a sense of going back to the earlier conversation of what's the execution strategy, which leads back to the founder himself or her, meaning do the right things and you will be rewarded, right? So now it's, again, short-term thinking, long-term thinking versus, hey, we want to have 50% of the tokens unlocked on TGE once it starts trading on some obscure exchange in Mongolia or whatever. So it's all about that. It comes back to no matter your advisory position or the influence you think you have on the team, the founding team ultimately will decide in how they want to play it. Now, going back to what I said earlier, we're humans, and actually a few founders told me this. Nothing annoys me more than I'm busting my ass, and I see VCs on Instagram buying Lambo after Lambo. So that builds resentment, and hence why they're like, hey, either we smooth it out over indeed 4 years, whether it's 4-year block by block unlocks, we're fine with that. Because it shows actually that the founder wants to execute in such a way that will be healthy for that whole token economy instead of indeed short-term thinking. Let's all move to Dubai next week type approach.
I got a slightly different take on it. I don't disagree with the fundamentals of what you said there. I think the underlying reality with all of these things, any public market, is essentially a prisoner's dilemma, right? We all hold this thing. We all want the price to be stable or maybe slowly increase. But I can sell now and you can sell now, right? So vesting terms don't change that underlying dynamic, right? And sort of like if what we're saying is we're sort of, we're pushing that problem into the future, it doesn't actually help you because things like dripping out tokens block by block, well, that just creates a lot of sell pressure forever rather than just around sort of like key vesting periods. I think sort of the other just on that idea, another thing to think about is why do we have vesting? One, it's to sort of like balance the needs and the sort of the benefits, I guess, of the different stakeholders. But the other thing that it does is it gives the project, the team, time to grow. And if what you're thinking about when you're constructing a vesting schedule, I think, is like what's the net increase in supply month by month, and then what are we doing to enable like more people to hear about the project, to sort of like develop the story, to bring on new users that sort of matches that. Because, you know, it's a highly adversarial way of thinking to go, well, what we want is exit liquidity, right? We hold these tokens, we hold a load of them, and actually what we want is someone else to go buy them, right? Well, actually what you want is you want the story of the project to grow, you want the users of the project to grow, and like, you know, like we talked about earlier, like hype is slowly replaced or supplanted or you know, enhanced by the fundamentals.
With more time, a project can then smooth out that curve because they have more holders, there's more liquidity. And so when investors do decide to exit, which is part of the asset class, you have to exit your investments at some point and return your fund to the LPs, the price impact will be less volatile.
I mean, in traditional market, you do need to have the normal startup to 7 to 8 years, right, before, or even 10 years before they actually be able to list. Here, you can see that there are projects that's, you know, only 6 or 12 months and that list, and they do need that time to develop as well. So you do, I think that the point of go-to-market cannot be sometime equivalent to IPO. You kind of have to think about overall period of time for a project to develop. I think you all touched on a good point about how you actually work with portfolio company. I think for everyone here, would love to hear about, you know, how each of you have, or your funds have been working with portfolio company and helping them through this journey.
I'll jump in there. So, I mean, we run accelerator programs, right? So we kind of have we invest, but we also put a lot of expertise and capability. We actually have 70 people in our team. We run sort of, you know, 12-week programs. We run token boot camps. So we, you know, that's kind of like core to our value add. I think you know, money is sort of like is fungible. It's sort of undifferentiated. If you can get yourself into a situation where you're sort of, you know, you're competing, then you do need to have something that sort of differentiates you, and ours is, you know, deep expertise in token engineering and token design. You know, how you sort of like put together a go-to-market strategy focused around the token launch itself, and community development. Those are our sort of like our key things, I guess.
I used to be a basketball coach, school teacher, work with kids with worse behaviors. So I come from that perspective. And I've been like a executive coach to a lot of the founders I've invested in, which I get close to. And the thing that my angle, obviously it's the classic, like help them get listed, introduced to a proper market maker, you name it. I call that the basics. The part where I find it more holistic approach is where, I'll tell you a story, for instance, whereby one founder, we had a TGE say on September 1st, and I got a call from the founder, and he said, my wife just filed for divorce. Right? So you're having that conversation, but the token is on Binance. My wife just filed for divorce. Right? So that human toll of running a global company with 50 employees in 20 time zones, it's incredibly hard. Right? And I actually tell them, like, hey, we're going to this dark room, and it's probably for the next 3 years, it's going to be dark, no exit. And I'll be here. I'll be here, and we'll pull through it. So it's not just indeed, many people think it's like, hey, help us fundraise. It actually often goes deeper than that, whereby certain founders come from poverty, and they're like, hey, this is my shot of seeing this through. We cannot fail, or this is my third startup. So you get involved in those conversations that often are not mentioned on the news or when they look good on a podcast or whatever. And you see them speak and you're like, oh my goodness, people should know how much, what it took to get here. It's actually way, way darker than you would often think.
I really, really appreciate what you just shared there, having been at one point an operator that was up at 3 a.m. and it's another 3 a.m. the next day, and you're dehydrated and exhausted, and you're trying to scale your organization. It's incredibly difficult. And I think having a 3 a.m. call is something that not every founder can say that they have. But on every cap table, hopefully, you have that angel investor or that VC like Etienne who you can talk with in those moments. The high-performance athletic experience, I think, is a great analogy. And I spent the first decade of my life training to be a professional athlete, and I wouldn't have gotten through it without coaches and without nutritionists and all of these supports. And so in a way, you can build your cap table to offer the same set of things. When I was choosing which firm I would join as a venture partner, Bain was very obvious to me because of its world-class research team. So one really interesting thing that Bain has done, I think, within the research space is contributed to and written several very novel white papers, which then lead to new protocols or new projects, and we work very closely with them. I also, in my particular capacity, work closely with advising portfolio companies, and that's often coming to the office and actually getting in front of a whiteboard and creating a plan, not just talking about best practices. Like, let's actually do this thing together, and that's been so fun for me over the last 3 months, applying all the learnings of scaling layer 0.
That's great to hear. My first question for a lot of the founders I talk to is, how are you? How's your health? It's funny because I actually want to hear about the health. The time I worked with M&A before, I was with 9 years, and I started working with a lot of founders and chairmen and the board. And the one thing I learned from early day is, as a founders and CEO, you're very lonely. You have a lot of responsibility on your shoulder, and sometimes you run away possibly in the next 2-3 months, and you have to launch a product. You also have to be responsible for the board, and you're responsible for all these humans that you're hiring and their wealth as well. If you have a price, that's your burden. That's a pride, but also a burden, because as a price change, not only your wealth change, but also the people around you change. And so I've always said, it's a lonely job, but also could take a lot of toll on your health. So if you haven't feel sick yet, you might be. So take it with you a night nurse, a paracetamol or something. And when you take vacation, that's gonna hit you bad, because your body tells you now you can relax. I think beside that point, obviously, at GSR, we are corporate VC, but we also have mandated as a VC as well. Beside a vast network of VC, we all work with you. I actually recently just announced a deal on the cap table with Bain recently as well, and we obviously work with Outlier and Etienne Fund too. So we know a lot of the top tier VC that we can connect you with, but also the exchange, the different partners that. Launching a token project is huge. Not just token, but equity project as well is huge. So you do need that network. But beside that, I think one thing quite unique about us is that we do have 200 people globally from different areas. And all of these have worked in traditional TradFi company before, where they are expert in their field. And in my seat, I'm able to bring in experts in different particular areas. So for example, someone is building a money market fund or a stable coin that rely on real world asset. I have someone actually work in BlackRock before, know how to actually build that product. We pull that person. Someone building a DeFi project and we need to do some sort of integration or checking how the product work, we actually be able to bring in that person to be able to help. And in different time zone too. So it's been really fun learning all of these from scratch. For myself and for all of these experts to be able to use their skill and knowledge before to help and contribute with the project. But I think for us, we all have...
Can I say something?
Yeah.
We go back to the token unlocks and when to sell. To be honest, and I partially agree with what you just said, Matt, is you get a bull market means almost free money. And I predict this, I talk to founders and I literally tell them this. Your token will go to X billion FDV. Please sell some, right? And one founder, Mr. XYC, he sold his house in the bear, so ignored this advice, sold his house in the bear, and then his wife called me. Are you Etienne? Did you advise him on this? I'm like, holy shit, I'm innocent. Wasn't my idea. So you get that lifetime, that life cycle, people go through that and trying to maneuver like, okay, I should have sold, I didn't sell enough, whatever, get into that conversation. And you're like, hey, sir, I've seen this many, many times, consider this, right? You're gonna get to that moment where you're gonna consider selling your token in the bear, or you're gonna have to fire 80% of your engineers. And that is going to slow down development again, and suddenly you're in this spiral of, it's a slippery slope you're going down without a helmet or parachute. So again, it's the human toll of running a token project globally where even I had another founder called me one day and he said they posted the picture of my daughter's school on Twitter because they think I'm not pumping the price enough. People do that. We do that, humans, right? And that is the part, obviously, we don't see in Forbes magazine.
Wow, there are definitely a lot of things to become a founder, right? Not just that you need to know how to build it, but you also have to be able to bear the pressure to build it.
Only crazy people do that.
Don't do that. But I think the time is up. I don't know if we have time for Q&A at all, so we don't. Yes, there we go. I think this is a very interesting discussion. I think we can go on for a long time as well. But I think hopefully that this will bring up some interesting part of discussion for the panels going forward after this. Thank you.
Thank you, Etienne and Matt.
Thank you.
That was a great discussion, and I would have loved to have had Q&A, but we are lunchtime now. We started off talking about meme coins, ended with advice for founders. Great conversation. We'll see you guys in a little bit after lunch. Enjoy.